Okay, welcome back. We've got Varun Goel now joining us. He's our Alpha Manager of the Day with the Mirae Asset Managers. Varun, great to have you with us here. Good afternoon. Thanks for your time. Appreciate it. Varun, the hunt for ideas is on. It gives the market gives very little space to do the hunting because we're mostly chasing. What is the team at Mirae doing, and where are you finding opportunities at these levels?
Good afternoon, Prashant. Thanks for having me on the show. I think if you look at the broader earnings, how earnings are placed at this point of time, we are looking at almost 1,000 rupees earnings on Nifty on FY24. You had 10-12% earnings growth for FY25, and then another 10-12% earnings growth on FY26. So we are looking at 1,250 rupees earnings on Nifty for FY26. On that basis, market is trading at almost 19-20 times. So there is no doubt that market is around 8 to 10% more expensive than the historical averages. Having said that, there are still pockets of reasonable valuations in certain sectors. We continue to like the banking and the financial services space. I think both on the lending and the non-lending side, we believe earnings growth will be upwards of 15% for the next 12 to 18 months. We are constructive on IT space, IT and pharma. I think clearly two sectors which look to be coming out from 2 years of consolidation and downturn, and earnings growth should definitely accelerate. I think specifically in IT, we've already seen this quarter that the revenue trajectory is getting better, and I think margins will catch up during the second half of this fiscal. I think as far as pharma space is concerned, clearly the US generic opportunity, which was out of flavor for the last 2 years, we are seeing better margins, better growth, and that should also kind of start contributing meaningfully to earnings. And the domestic formulation story has always been strong. So I think IT, pharma, select banking, select capital marketplace, and some of the discretionary consumption sectors continue to do well. And that is where we are finding incremental opportunities to invest.
Okay, all right. Hi, Varun. Good afternoon, and good to see you win. Wanted some further clarity as well in terms of, you said, I think, pharma as well as IT, and you gave us a little bit insight into IT. Earlier, I recall, you were quite positive on some of these hospital stocks, and some of them have done very, very well. From the healthcare space, what's the call now on the hospital stocks?
Yeah, good afternoon, Nigel. So I think definitely hospitals is a secular growth story. I think as more and more people in India use health insurance, we are going to see more and more people going to tier one healthcare service providers, and therefore hospitals should continue to see better occupancy, better growth. I think we are still looking at only 10-15% formalization in this sector. I think there is a huge way to go, and as such we remain constructive on players, especially on tier 2, tier 3 India, which are expanding on a capital light basis. So I think this theme will continue to do well. I think diagnostics also, we saw significant price wars in the last 2 years. I think things are kind of settling now, and the players which are able to provide a reasonable quality service at a good price should see healthy growth going forward. So both the spaces within the healthcare segment should continue to do well going forward.
Varun, afternoon. Reema here. I remember past conversations where you said that you were cautious on these new age tech companies. But since then, a lot has changed. These companies have sharpened their focus on profitability. There are more companies now coming up in the market. You've got Ola Electric. First Cry is also planning to go public very soon. Would you be looking at any of these new age tech companies now?
Yeah, good afternoon, Reema. So I think we are definitely looking at companies where we see profitability is around the corner. There are some companies which are seeing significant improvement in operating metrics in the last 6 to 12 months. I think some of those names should see better traction in both profitability, EBITDA margins, and volume growth. However, I would personally still be careful about those companies which are very far away from profitability, and the valuations still continue to be a challenge in several of these stocks. So it's really a pick and choose kind of a thing as far as this space is concerned.
Okay, got that. By the way, just want to point out that we've got two high-flying PSU stocks which came out with numbers. Now, the quarterly numbers are not very high-flying. Of course, the usual caveat applies. These are companies on the capital goods side, long gestation projects, etc. But anyway, for what it's worth, look at REITs. The margin has come down a lot. From nearly 30%, it's down to about 22%. Stock obviously sold off the moment those numbers came in. The profit is down about 25%. Revenue itself is down about 11%, and both, of course, EBITDA and EBITDA margins have compressed. Right, it's not looking too great. Come to BHEL, still got losses here going, like last year. Losses at the net level, losses at the EBITDA level as well. So that situation hasn't really improved. Top line is up about 10%. So the question really is that with the market so excited on these names, how do you sort of deal with some of these disappointments that come along the way with respect to earnings? Varun, hi. What is your stance? PSU stocks, and this is the thing. We always talk about execution, whether earnings will be as consistent as the growth in stock prices. What's your take, and what is the position you're taking on these stocks?
So I think as far as capital goods space is concerned, there is no doubt that we are in the midst of a capex cycle. I think be it private capex, either in terms of residential property or PSU capex, central government capex, we are seeing very strong traction. However, valuations in some of these spaces seem to have run up quite a bit, and valuation is clearly a challenge. In our view, power is clearly a space which stands out in terms of very strong and ambitious plans for the next 5-6 years. India hasn't really added a lot of thermal capacity in the last, I think, decade, and therefore there will be some catch-up. We also need that to kind of balance the renewable energy. So power generation, power transmission will continue to be a space which will see good growth. So we'll really pick and choose in terms of players which are available at a reasonable valuation. I would be more careful about the railway and the defense sectors where valuations seem to have grown manifold. I think defense, while there is clear runway for growth, I think next 4 or 5 years we are going to see strong improvement in growth both on top line and bottom line because of the huge export opportunity. But the valuations seem to have kind of gone too high, and therefore one needs to be a little more careful as far as some of these pockets are concerned.
By the way, across the sort of market cap curve, we talked about many sectors, etc., that you like. Are you tilting more and more towards large caps naturally, organically, because valuations?
Yeah, so I think broadly from a valuation point of view, there is no denying that as a whole at aggregate level, large caps are cheaper than the small and the mid cap space. However, one has to keep in mind that there are certain themes and sectors which are not available in the large cap space. And therefore, we believe some of those themes which are there in mid and small cap will continue to do well because the growth runway seems to be much larger. But having said that, yes, broadly, I think large cap space is definitely cheaper, and that is where we are beginning to find more new ideas as compared to the mid and the small cap space.
Okay. All right, Varun, we will leave it on that note for today. Thank you very much for joining in. Good to get your perspective on the market. Well,